Why do 90% of people always lose money? Most people enter the market with expectations in their minds. However, the market often rewards you at first. And then, when you're least prepared, it takes everything away at once. That's why most investors don't lose money slowly. They lose it all in a few key decisions, giving back all of their past gains in one shot. When an investment makes money, people tend to take credit for it. But when it loses money, they blame the market, the news, or external factors. This psychological mechanism protects the ego in the short term. But in the long run, it prevents real growth, because a mistake you refuse to admit can never be corrected. Long-term studies show that investors who lose money all have one thing in common. They rarely review their decisions. They only look at the outcome. A stable long-term investor doesn't ask over and over, "How much did I make?" but rather, "Why did I make that decision?" So why do 90% always lose money? Because most people don't understand the market. Now, I'm going to teach you how to understand the basic sentiment of the market. Bullish and bearish candles. This is a market dominated by sellers. The market rejected higher prices. The candle opens higher and closes lower. Imagine a negotiation. The buyer tries to push the price up, but the effort is rejected, no matter how much noise there is along the way. And no matter how high the price, when the final closing price is the real result, the buyers couldn't maintain the higher price before the close. Sellers took control of the market. This is a market dominated by buyers. The market rejected lower prices. The candle opens lower and closes higher. Imagine a negotiation. The seller tries to push the price down, but the effort is rejected, no matter how much noise there is along the way. And no matter how low the price dropped, the final closing price is the real result. The sellers couldn't maintain the lower price before the close. Buyers took control of the market. We're not trading the candles. We're analyzing the market's reaction after the transaction. Candles do not predict the future. They reveal pressure, not certainty. Candles are not tools for fortune. They are tools that expose the weaknesses in the market. Once you understand this, trading becomes much easier. Support and resistance. After bullish and bearish candles, the next question is simple. Why does price stop moving at certain levels? That's where support and resistance come in. Support is not a line. Resistance is not a line. They are areas where the market remembers. Support is where selling pressure weakens and buyers start stepping in. Resistance is where buying pressure weakens and sellers begin to push back. Candles show you where the fight happened. Support and resistance show you where it is likely to happen again. A bullish candle at support means buyers defended that area. A bearish candle at resistance means sellers defended that area. This is why candles and levels must be read together. Candles show intent. Levels show context. Without levels, candles are noise. Without candles, levels are blind. When both align, the market becomes clear. This is how traders stop guessing and start reading the market. Trading volume. Price alone is not enough. Volume tells you the truth behind the move. Volume answers one simple question: who is actually participating? Price can move on low volume, but those moves are fragile. High volume means commitment. It means real money is involved. Low volume means hesitation. It means the move can disappear quickly. Here's the key point most people miss. Volume does not tell you direction. It tells you conviction. A rising market with declining volume is losing strength. A pullback with strong volume can signal accumulation. You don't need complex volume indicators. You just need to ask, is participation increasing or decreasing? When volume confirms price, the move has a higher chance of continuation. When volume diverges, be cautious. Volume doesn't predict the future. It exposes intent. Support and resistance role reversal. Many traders learn to draw support and resistance, but they start losing money at the critical moments. The reason is simple. They don't understand role reversal in support and resistance. Here's the key concept. The market is not static. When a support level is broken decisively, that support doesn't disappear. It simply changes its role. The former support now becomes future resistance. Why? Because the traders who bought at that support are now trapped. When price comes back, their first instinct is to sell and get out. The same logic applies to resistance. When a resistance level is broken, it becomes new support. Those who shorted at resistance are now forced to stop out. When price returns, they hesitate to sell and become potential buyers instead. This is role reversal. It's not magic. It's human psychology. Support and resistance switching roles is really just a shift in market control. Professional traders don't just ask, is this a support level? They ask, is this support holding or has it been broken? Holding support is a defensive zone. Broken support is future resistance. When you start thinking in terms of roles, not lines, the market suddenly makes sense. Higher highs, lower lows, trend direction. Markets are honest. They tell you direction in one way, through the arrangement of highs and lows. When the market keeps creating higher highs and higher lows, this is called an uptrend. It's not just that price is rising. It's that buyers are willing to pay higher prices each time. On the other hand, when highs get lower and lows get lower, lower high, lower low, this is a downtrend. It's not just that price is falling. It's that sellers are acting earlier and stronger each time. Trend is really about who is in control. As long as higher high and higher low persist, the bulls control the market. As long as lower high and lower low persist, the bears dominate. The biggest mistake beginners make is trying to buy in a downtrend or sell in an not because they don't understand, but because they don't trust structure. Professional traders always ask, has this high been broken? Has this low held? When structure changes, the trend changes. Until then, any countertrend trade is purely a matter of luck. Range sideways market. Not all markets are trending. In fact, a large portion of time, the market is trading sideways. Sideways doesn't mean nothing is happening. It means the market is hesitant. In a range, highs are not broken. Lows are not broken. Both buyers and sellers are testing each other. But no one wants to commit. Many traders get impatient here. They get chopped and start doubting their strategy. For professional traders, sideways is information. It shows energy is building. Volume shrinks. Volatility drops. Price compresses. Nothing is random. The market is preparing for the next move. Sideways ends in two ways: break up or break down. The key is not the breakout itself, but whether price can hold after the breakout. If the breakout fails, that's a failed structure. If the breakout holds on retest, that's a true confirmation of direction. In a sideways market, the best strategy is not to predict, but to wait. Wait for the market to make a choice and then follow. The market will always give opportunities. The question is, are you patient enough to be there? Nothing is impossible. If you enjoyed this video, hit like, leave a comment, and share it with your friends. Subscribe and support us to help make the impossible increasingly possible.